Obviously, first thing first is how good it is to be back in person with you. Yeah, exactly. We did a couple of years remotely. Let's all acknowledge that sucks. And it's so nice to be back. But with that, I have two, obviously, a little bit of sadness. First of all, Mark, where the hell are you, Mark? What the hell are you doing back there? How can I do this talk without Mark hovering over my right shoulder, looking at his watch in panic as I rattle on endlessly? I don't know how I do without that. Now, of course, the other thing is it is a little quieter this year, a little less rowdy. Both good and bad. I think at some level, at least I don't have to scream my points. And we will have a little time for Q&A at the end. So we'll be able to, shall we say, have a little bit more of a parlay. And maybe we'll have some different questions this year, which will always be nice. Now, 3 years since I've been with you in person, it has been, to say the least, a very interesting 3 years. And when you come into, of course, 2022, well, as I do with most of my presentations, let's start with the headlines. 98% chance of a global recession. Jamie Dimon, economic hurricane. Zandy's calling for a full-blown correction. Stocks has entered the bear market. Gas is $6 a gallon. Consumer confidence is collapsing. But then again, 2 years ago, it was the same chaos, right? Remember 2 years ago, beginning of the pandemic, and we heard how Zandy said that 30% of Americans with home loans were going to stop paying their loan, and we were going to have a depression, and 40 million people in America could be evicted. The coronavirus will scar the U.S. labor market for the next decade. Little did you know that by what they meant by scar is you cannot hire workers because they're not available. You didn't think it was that kind of scarring, did you, right? And of course, remember, this all goes back to 2019 when I was here, when we were all panicked, of course, about the recession that was going to happen. Not because of a pandemic. No one was talking about COVID then, but they were freaking out about real estate and, right? We all know where this goes, right? Right? You know, remember what this is? Miserableism, right. You got it. Bingo. But this is chapter 2. This is chapter 2 now. It's all fun and games until somebody really fucks up the economy. And that is where we are, right? Because when you think about where the economy is today, this is exactly what was going to happen because of this incessant drip, drip, drip of miserableism. Look, navigating the hysteria. A lot of people came up to me today, do you have good news? It depends what you mean by good news. That's what everybody said to me. Oh, what do you mean by good news? Yes, I kind of have good news, but I kind of don't. Because the good news is it isn't as bad as they tell you. The bad news is they are still completely out of touch with reality. And this is where our problems exist. Right off the bat, someone needs to send a telegram to Washington, D.C. and explain to them that not every single shock to the economy is an existential crisis. In this era of miserableism, every single thing takes on an outsized proportion. There's no other way of putting it. 2 years ago when I talked to you and we talked about the pandemic itself, I said, look, there's no doubt this is a tragic circumstance, but as far as economic shocks go, it isn't that big of a deal. But you know what? Don't let that get into the miserablest shell called politics, because they freaked out, they heard all the nonsense about depressions, and they overstimulated the economy like crazy. Well, now we're dealing with the after effects of overstimulating the economy, namely, obviously, interest rate increases, inflation, and yada, yada, yada. And they are now treating those symptoms as another existential crisis. And here we go again, where they're jumping up and down to the brakes called the federal funds rate, and they're creating all sorts of chaos within the economy. And, you know, it's not just Washington, D.C. When I think about what Sacramento is doing and how they stumble from existential crisis to existential crisis, and we realize that politics has devolved into not coming up with the best solutions with the problems that confront us, but rather coming up with solutions for the problems that don't confront us. And it's that imaginary world where they are running around solving problems that don't exist, where the true danger to our economy lies. So for those of you who are running up to me saying, are you going to have good news tonight? Well, no, because politics is still completely out of touch with reality. On the other hand, this is not a recession. Anybody who thinks we're in a recession or going into a recession has no idea what they're talking about. Yes, the U.S. economy is flopping around. Yes, the first half of the year we saw a tiny contraction in economic output, but that's just because of the violent changes in the underlying structure of demand. There's nothing wrong with our economy in terms of our ability to keep up with demand, except for the fact that demand is moving so rapidly, we can't keep up with what that structure is. There's so much pent-up consumer demand in this economy. I can't even begin to tell you. Wait till I get to some of the numbers in terms of just basic cash balances in American households. If the American consumer keeps going, and guess what? They're going to keep going, the rest of the economy will follow along behind them. And as far as inflation goes, look, it's going to burn out on its own accord. It will. They printed X amount of money, and at some point in time, prices catch up, and that's that. We don't have to worry anymore. So it isn't as bad as you think it is. But unfortunately, the excessive overreaction to the inflation is creating pressures in parts of our economy that, of course, are important to people, particularly people in this room, because they are starting to create chaos in the asset markets, even if the core underlying consumer demand part of our economy is remaining strong. I mean, look, asset prices and business development went through the roof over the last couple of years because of the stimulation. Now they're pulling back, stepping on the federal funds rate, and things are cooling off rapidly, as well they should. It was too much in the first place. But take, for example, real estate. Real estate is a classic sort of, and we're going to talk a lot about real estate today. Look, real estate has gone ice cold, but it's not a collapsing bubble. This is not 2008. It is not 2009. It's not as if the sky is falling in. But when you go from a 2.5% mortgage rate to a 7% mortgage rate, the pipeline freezes up. But the fundamentals of real estate demand are fantastic. And, you know, in 2010, we didn't have enough buyers. In 2022, we're not going to have enough sellers. That's the biggest problem in real estate. It's a completely different kind of situation, and one that, yeah, is going to be problematic, but, you know, it's not the end of the world to say it the way it was 12 or 13 years ago. So it's just something we have to get through. With all that in mind, things aren't fine. The things I worry about are a couple-fold. First of all, the economy is very brittle. When you have a high inflation environment, when you're going through these kind of transitions, if we did have a real shock to the system, I don't know how it's going to play out. It's something we all have to pay attention to. As far as the Federal Reserve goes, they're completely out of control. They don't seem to have any grounding in reality, which all by itself is a scary circumstance. I don't know how far they're going to push this. Look, I don't think we're going to have a recession right now. However, if the Federal Reserve pushes the federal funds rate to, I don't know, 9%, can we all agree we're going to have a recession? The question is how far will they go? Well, I don't know. And then, of course, let's not forget the federal debt. I'm going to get some numbers in the federal debt, but they're truly scary. Let me put this in a little bit of context. In the last 2 years, the federal government has borrowed $20,000 for every single person in this nation. By the way, that's on top of the $40,000 they borrowed for everybody over the preceding 18 years. And right now, we have a well over $1 trillion structural budget deficit. Here's the scary thing about it. For anybody in the room who's nodding your head because, you know, those evil Democrats, nobody in D.C. is talking about this. Left or right. Nobody's talking about it. And anybody who thinks the Republicans are the fiscal disciplinarians, only when they're not in power, people. So forget about it. We have an enormous issue out there that we haven't even started to talk about. And that's what scares me to death. And that, of course, goes back to my final point, which is, again, politics is still in the land of miserableism, and that is a dangerous place to be. Again, it's all fun and games until you really screw up the economy. When does this end? And on that one, I have no answers for you whatsoever. Now, as always, tons of data. I'm going to try to go through it rapidly, at least before Mark starts getting upset in the back of the room. Of course I'm going to pick on you. You're here. We miss you. Let's get into it. Mixed economic signals, no doubt about it. First half of the year, negative economic growth, complete collapse in U.S. consumer sentiment. Google searches for recession through the roof right now. The Wall Street Journal next recession survey, over a 60% probability of a recession in the next year, according to the Wall Street Journal economists. Yeah, okay, all well and good, but this is not a recession. And yeah, I'm going to come to this in just a second, but what is a recession? I always love this. The newspapers go, well, it's 2 quarters of negative growth. Oh, yeah? Well, if that's a recession, turns out the pandemic wasn't a recession. Because the pandemic was about 8 weeks of negative growth, and we started growing after that. How does that work for your model? Clearly not well. A recession is a period of time where the economy is underperforming. There's excess capacity that's not being used. People want jobs they can't find. Factories want to sell stuff, but they can't find buyers. That is what a recession is, excess capacity. Industrial production is at an all-time high level, and the unemployment rate is at 3.5%, basically the lowest it's been in 50 years. How can you look at this economy and pretend it's in a recession? Clearly, that's not the circumstances. Simple as that. And oh, by the way, the GDP Now numbers, which is kind of this ongoing estimate of growth in the quarter on the basis of more current indicators, suggests a growth rate of over 3%. They've been aiming a little high, but that still says probably 2 to 3% growth in the third quarter. So whatever this recession is, we're going to see growth in the third quarter. Let's move on and stop panicking. Where all this chaos, of course, begins, goes back to the pandemic itself. The pandemic, no doubt it was tragic, but it was not a depression-causing circumstance. It was a different kind of recession. Certainly it was scary. The economic statistics that popped out were alarming. The unemployment rate in 2 months went from about 3.6% to 14%. I get it. But just because the unemployment rate goes up doesn't mean it's the same kind of unemployment. I'm a forecaster. That means I use all sorts of sophisticated vector autoregression models. And what I was taught in grad school by my dissertation advisor is, believe your model, but never believe your model that much. And it was an important lesson that too many economists have completely forgotten. These are statistical estimations based on the broad assumption that in 50 years of data, things have been largely the same. They haven't. From any statistical standpoint, we don't have enough data to truly understand business cycles. So you have to use theory and logic and understanding. And here's the basic reason that 2 years ago when I talked to you, I said, this isn't a big deal. Because I recognized that it was a different kind of shock. It was a supply shock, not a demand shock. The Great Recession was a demand shock. The collapsing subprime bubble absolutely collapsed household wealth. And the net result of that collapse in household wealth was that people had to start saving. And when they all started saving, they couldn't spend, and that prevented the economy from growing. And because the economy wasn't growing, it was hard for people to save. That was the trap we found ourselves in that made the Great Recession a 9-year business cycle, a year and a half down, and 7.5 years to fully recover. The pandemic was not that. It was a supply shock. What do I mean? In 2010, you didn't go to restaurants because you couldn't afford to. In 2020, you didn't go to restaurants because you weren't allowed to. And the difference is profound. It wasn't spending canceled, it was spending transferred. It was either transferred to the future or was transferred to goods, which weren't closed down. And if anybody tried to buy a bicycle, a hot tub, a boat, a camper, anything that wasn't nailed down in the damn shop, you know what I'm talking about. It got purchased. Simple as that. So of course, it wasn't going to be that bad of a circumstance, but don't let logic intrude on politics. That is a surefire lose for an election. So what did they do? They went to town. $6.5 trillion in fiscal stimulus. This is federal expenditures as a share of GDP. This is our minute effort at the back end of the Great Recession to help fix things. Look what we did this time in the face of a much more moderate shock. Insane. Just take households all by themselves. Households lost a little over $800 billion in income over the course of the pandemic because of the economic interruptions that occurred. $800 billion. In return for their troubles, they were given $2.1 trillion in direct transfers. For every dollar of lost income suffered by households, the federal government gave them $2.50. And by the way, that's only a third of the stimulus. There's still $4 trillion plus that they lobbed in every direction. Now, one of the big questions is how the hell does the federal government come up with $6.5 trillion to spend in 2 years? Where do you come up with that kind of cash? If you went to the bond market to borrow it, you collapse the market. Well, you didn't have to. You had Jerome. Because, Jerome bought into the narrative. He's a politician. Everybody in the Federal Reserve Board is a politician nowadays. If you hadn't paid attention, that's what happened. They've been politicized. You got picked for the Federal Reserve positions because of the narrative you spoke or the demographic checkbox you filled, period. And as a result of that, they got into the action. And of the $6.5 trillion in fiscal borrowing that went on, $5 trillion of it was funded by money printing. $5 trillion in quantitative easing. Now again, let me give you some context to how out of control that was. Ben Bernanke, who just won the Nobel Prize, did $3.5 trillion. $3.5 trillion of quantitative easing. But he did it over 6 years. This clown, and I mean that in every sense of the word, did $3 trillion of QE over lunch. And then he followed up with $2 trillion more over the next 2 years, despite the fact that we didn't have any problems. Because Ben Bernanke was doing quantitative easing for a very specific reason. Do you want to know causes of depression? It's not a pandemic, okay? What causes a depression is a bad recession combined with deflation. This is one of the reasons why going back to commodity standards is a terrible idea. You think going back to the gold standard is a good idea? No, it's preposterous. Because when you have deflationary pressures and you have a bad recession, that will turn it into a depression. Every depression is a combination of the two, okay? So Ben Bernanke saw us going into a really bad recession and responded to it by, of course, printing money to offset the deflationary pressures of that financial bubble collapsing. But this time, there were no financial pressures because this wasn't a collapsing bubble, it was a pandemic. Bank charge-offs were 3%. This time around, they didn't exist. Back then, home prices were falling 15% per year. This time, he managed to spike them to go up 20% per year. Back then, we had record foreclosures and bankruptcies. This time, there are none. He wasn't fighting any financial crisis. Now, the result of this, of course, is, again, apparent. Money supply. No more, no less. Top line there is a 3-year growth rate in M2. That's our broad basis of money supply. The lower line is a 1-year growth rate. And I just want to give you a sense of the difference between Ben Bernanke's term and this guy. Ben Bernanke did just enough quantitative easing over 3.5 years, 4 years, to offset the deflationary effects of that collapsing bubble. Money supply nice and steady. This time there wasn't no financial bubble. He poured money into the economy, and as a result, the money supply grew like nobody's business. Now, you don't have to be a rocket scientist to figure out what happens when you do this, okay? You just don't. I think I've mentioned this if you've tuned into one of my webinars I've done over the last couple of years. I talk about this book, Money Mischief, that was written by Milton Friedman, written in the early 80s. A fantastic book. It's 250 pages or so. Easy reading, costs $14. I think I learned more about money and banking from that book than I ever did from my PhD level textbook I read, right? And I'm pretty sure that nobody in the Federal Reserve has read it, okay? Because when you expand the money supply by 50% in a very short period of time, well, it's pretty clear what's going to happen. He goes into this in the book. You pour money in the economy, and the first thing that happens is money illusion. When money illusion kicks in, you have, yes, this fantastic rush of good feelings. Interest rates fall. Asset prices go through the roof. Consumer spending and business investment take off like nobody's business. The economy is charging forward. Everything's great. Kind of like how things feel great after you drink, 2/3 of a bottle of tequila. You see, that's the problem. At some point in time, the alcohol wears off, and then you're left with a hangover. And that's exactly what happens here, the hangover. When, of course, the big money supply increase wears off and the money illusion starts fading away, suddenly you have inflation, interest rates start to rise. You deal with, of course, the secondary consequences of sharp transfers of wealth from savers to borrowers, from people with fixed income to people with non-fixed incomes. Investment risks start dramatically, and that causes a decline in real investment. And asset markets, of course, implode on the back end of their big rise. And that's where we are right now. Now, of course, that's not what they talk about, but let's go through the mechanism real quick to understand this, okay? Because you have to understand how this thing works. So they poured all this money in the economy. People couldn't even spend it, and so they just put it into wherever, right? You put it into 401k, you put it into your stock portfolio, you put it in your bank account, you put it anywhere you could. And of course, when people start pouring money into financial markets, by the way, I did a PhD at UCLA. I actually have a PhD in management, so I took a bunch of finance courses, and I learned this garbage called efficient markets. You could throw that crap out the window, I'll tell you that right now. I can't believe the nonsense they taught us in grad school about efficient markets. Oh yeah, every stock is worth the net present value, the infinite estimate of future profits for the company. I'm a good forecaster. I can see 3 years max. Really? So, of course, you pour all this money in the economy, asset prices take off like nobody's business, and you have a huge asset bubble. How does this pan out? The $6.5 trillion in fiscal stimulus led to $30 trillion of new household net worth because the stock market took off, and housing markets took off, and the venture capital took off. Everything took off, and asset values went through the roof, and that fed back, and people felt rich. That's a 25% increase in household net worth in 2 years. And it's not just Jeff Bezos and company. Indeed, so much of the money got sprayed out that a lot of it went to the bottom 50%, which isn't a bad thing, except for how they did it, all right? And the net worth of the bottom half of the pyramid went from $2 trillion to $4.5 trillion, 100% plus increase of net worth at the bottom of the pyramid. That money very quickly turns into consumer demand. So yet again, the economy goes on fire. And that's exactly where we are. We're in the midst of a binging economy, not a contracting economy. Take a look at, for example, the trade deficit. It's now 5% of GDP. Real imports are going through the roof. Everybody's been wringing their hands talking about these huge problems with the supply chain. Oh, supply chains can't keep up. They can't keep up. Of course they can't. They've never been designed for this level of real imports. We don't have enough boats. We don't have enough planes to bring stuff in. And by the way, that might not have been a bad thing, right? Now, of course, at the back end of that, inflation takes off. Of course it does. Inflation is nothing more than what happens when there's too much money chasing too few goods. We have too much demand relative to the actual ability for our economy to produce them. Prices have to go up to re-equilibrate. This is exactly what you would anticipate. And we aren't the only country, by the way. In fact, the entire world, most of the world, is suffering from the same big increase in inflation because they overdid it. The Japanese overdid it. The EU overdid it. The Britain overdid it. Most countries overdid it. And inflation has become a worldwide phenomenon because we printed too much money. Simple. Except for you can't say that out loud. I mean, we printed too much money. That's why we have inflation, right? Oh, not in D.C. In D.C., it's those supply chain issues. Oh, no, it's the federal deficit. That's the problem. Oh, no, it's those greedy corporations, right? Or how about Biden? Not enough manufacturing jobs. He said that multiple times, right? Biden's bad green energy policy. That's the right coming at him again. Oh, now they're all happy. It's Putin's fault. What next, right? Kim should have dumped Kanye, right? All right? Or maybe it's because Will slapped Chris, right? Or I don't know, it's the hot air from all these election speeches. There's got to be a reason. Well, yeah, there is a reason. Again, folks, Milton Friedman, the guy won the Nobel Prize. He spent a career studying this stuff. Inflation is always and everywhere a monetary phenomenon unless you're in the federal board chair room. What the hell is going on? Well, you can't talk about this. You're not allowed to. Remember, in the miserableism bubble called Washington, D.C., 70% of Americans are starving on their feet. They're living paycheck to paycheck. One paycheck away from being homeless. We're in a nation in decline where millennials can barely scratch together a living. In their bizarre world, to say out loud the reality, which is, yeah, we have inflation because there's too much consumer demand, you can't say it. This is the problem of miserableism. This is our issue. We can't point out the obvious. Well, you better start needing to. And a classic case of this is the conversation around gasoline. How much have we heard about how tragic gasoline prices are? Well, let's talk a little bit about gasoline. On the bottom here, this is standard Q and P. You remember those old graphs from your class? And these are different equilibrium points. These are different months, and this is the quantity of gas we buy and the price we pay for it, right? And then, of course, we had the pandemic. Woo! No demand for gasoline, big decline gasoline, gas prices fall. Got really cheap because nobody was driving. And over the last couple of years, look what's happened. Huge increases in prices. I don't see any decline in consumption, or so little it's almost meaningless. Well, the only reason you have a little bit of supply constraint that turns into a 100% increase in gasoline prices is because there's so much demand for gasoline. And, for all the quote-unquote huge hike in prices, has anybody seen the traffic get better? Anyone? It's chaos. This is clearly a demand shock. But no, you can't say that out loud. It's a supply problem, and everybody's suffering. And that's why, of course, these forecasts for inflation are so stupid. This is great. I wish we didn't pull this together. I just swiped this from somebody else. But these are the forecasts for inflation with the actual patterns in inflation. And I'm not sure what's funnier about this. It's like, how could these forecasts be so stupidly off month after month after month? And more importantly, how can the markets be so surprised? Inflation is more than we expected. And it's like every month. They never learn. I call it a dog's memory. Who has a dog? A few of us have a dog, right? You know what a dog's memory is? Every morning you leave the house to go to work, it's the worst moment of your dog's entire life. And every day when you come home from work, it's the best moment of your dog's entire life. And you're like, aren't you going to figure this out, Chief? Apparently not. Now, why did oil prices going down not lead to a decline in inflation? Because gasoline prices came down. When you have excessive demand, the money you saved at the gas pump, you just spend on something else. When it's too much demand, it doesn't matter where the money's going. It's going to go somewhere. And talking about supply problems, you're missing it completely. You're absolutely missing it. Now, how much for will inflation go? Well, if you just look at the basics of money supply compared to the size of the economy, I don't know, about 10 to 25% more is what we need to do to re-equilibrate, if you will, the money supply with the size of the economy. And that's what you're going to have to do. When you print that much money, this is how much prices have to go up to re-equilibrate. As simple as that. And it's going to happen. But, again, world of miserableism. There we go. The Federal Reserve is now acting as if the inflation is an existential crisis. How many stories have you heard about how awful inflation is for American consumers? How many stories have you heard about how many people have seen this article in the newspaper? How you can make your pennies go longer in the supermarket. Have you seen these stories? Has anybody been to a mall or a supermarket lately where people look like they're worried about pennies? Now, I'm not suggesting for a heartbeat that some people aren't suffering from inflation. Of course they are. But the people who are suffering from inflation are a minority of the community, and we need to worry about them. But the idea of running around and pretending that that small group represents the majority of Americans is missing the story completely. But no, now they must conquer inflation. And they've turned inflation into this huge issue in the election. The Republicans are using inflation as their sledgehammer. It's all Biden's fault. Well, actually, it's Jerome Powell's fault. And by the way, most of QE took place before Biden became president, okay? It's not that. So what do you, I'm not going to go back. So obviously, he's jacking the federal funds rates up above 3%. He's pushing interest rates up, and yeah, the era of cheap money's over. Mortgage rates are up to 7%, 10-year bond at 4%. The 10-year, 3-month T-bill spread is falling. And yes, as interest rates are kicking in, so too, of course, are the asset markets starting to subside. I've heard about this bear market in the stock market. I don't know. When stock prices go up by 50% and down by 20% in 2 years, as far as I'm concerned, you're still up by 30%, okay? It's not a bear market. It means, reduce your expectations. Which, by the way, is the key to happiness. If you haven't figured it out, reduce your expectations, it makes life marvelous. To be clear, the PE ratio is probably still too high. I love this. Billion-dollar tech funding rounds becoming more rare as layoffs, CEO resignation, belt tightening. Well, of course. Look at venture capital last year. Did you really think that was sustainable? Did anybody really think that you could double venture capital in a year and it wasn't going to cool off at some point in time? Yes, I'm sorry. Reality sucks. Get over it, people. All right? This wasn't going to last. There wasn't that many good ideas. Come on. Right? It's just as simple as that. Bitcoin's down to $20,000. $20,000 more, it'll be back at its fundamental par value. I'm so exhausted by this Ponzi scheme. What is wrong with us? Let it go. It's garbage. Move on. So yes, GDP growth has slowed pretty sharply over the course of the last year or so. But look where it's slow, right? Consumer spending is overall weakened, but it's still up. Big pullback in structures and residential investment, not a surprise given the big hike in overall interest rates. Government's back, but government's negative because of the decline in spending. But what's interesting is spending is still growing. Consumption is still growing. It's our production that's actually going down. And what you see here, of course, is that we're consuming different kind of stuff. We're getting more of this from overseas, a widening of the trade deficit, more of this out of inventories. It's not that. Now, if you want to think about where the economy is going, you have to first ask the question, where's the consumer going? Look, consumer spending is 70% of the U.S. economy. If the consumer is strong, the economy will persevere through pretty much anything. Where is the consumer going? Is the consumer being so crushed? Of course not. A couple of things here. First of all, we've had, again, everybody deep breath, 1 year of bad inflation, 1 year. 1 year, And it's not really even that bad because the actual number, the PCE, is about a little less than 7%. That's in the back end of 4 years of low inflation. Over the last 5 years, Americans have seen about a 16% increase in prices. In 2006, after 5 years, it was 17%. So this isn't even the worst inflation bout in the last 20 years, much less the last 50. Context, 1979. And in 1979, over the previous 5 years, there had been a 50% increase in prices. That's inflation, people, okay? Get over yourselves. And as for interest rates, oh yeah, okay. Yeah, interest rates are coming up, there's no doubt about it. In nominal terms, the 10-year bond is running 4%. Inflation is about 7%. That means in real terms, it's a negative 3% interest rate. You borrow $100 today, you pay back $97 at the end of the year. It's kind of a good deal when you think about it, right? So again, let's be honest about where we are. There's still pent-up consumer demand. Look at autos. For all the quote-unquote impact of inflation on consumers, there is still less than 100,000 cars for sale in the entire United States right now. Less than 100,000 cars. 5 years ago, 1.2 million. Again, really? As for cash itself, look, we all refied our mortgages at really low rates. As a result of that, the financial obligations ratio is really low. Most of those financial obligations are linked to mortgages, which are fixed. For all the hike in interest rates, households aren't going to see a big increase in that. And here's the statistic I love the best. On the right-hand side, this is cash on hand for American households, okay? Prior to the pandemic, American households had about $1 trillion sitting in their checking accounts. Right now, $4.6 trillion cash just sitting there, waiting to be spent. And if you wanted to break it down, here's an index by level of income. So, for example, people in the 90th to 99th percentile, they're hanging on to about 250% more cash than they were pre-pandemic. Those from the 50th, 90th, they're about 300%. Those in the bottom 50%, they're about 250%. There is so much cash sitting in our economy today. And you know, if you don't believe me, just look at restaurants. They're still packed, right? Everybody's going abroad. There's crazy amount of foreign travel going on. Look at Las Vegas. Look at gaming revenues on the left-hand side. Just focus on that number for a second. This is through August. Gaming revenues today are, no kidding, 30% higher than they were pre-pandemic. Without Chinese visitors coming in, without conventions coming back fully. Really? Are Americans suffering? The blackjack table says otherwise, okay? And the blackjack table speaks very loud. And what's funny about this, so the Federal Reserve is responding to inflation by cranking up interest rates, which, by the way, isn't hurting consumers at all because they're sitting on piles of cash. Consumer demand is going to remain there, which means inflationary demands are going to be there. They're not helping anything. And what's even more bizarre is now, of course, we're freaking out because of inflation. And federal government, the Inflation Reduction Act, one of the most ironically termed acts in the history of politics. Because what it does is it expands the budget deficit for the next 2 years, thus increasing inflationary pressures, right? And oh, by the way, who's gotten your gas rebate? Anyone? Anyone? Do you know what the cutoff for the gas rebate is? If you have 2 kids, the cutoff, $400,000 a year. If you make less than $400,000 a year and you have 2 kids, that's me, by the way, I will be getting $700 from the California state government. I'm pretty sure I don't need $700. Why are you doing this? Absolute chaos. Now, businesses, they're fine. Profits are still up. Corporate debt to equity ratios are relatively low. As far as IT goes, yeah, I get it. There's some valuations, venture capital's fading away. But look at new orders for IT equipment going through the roof. Scientific research and development job postings on Indeed starting to come down, but still a hell of a lot higher than it was pre-pandemic. So really, when you think about businesses, their biggest problem, of course, remains, well, a lack of bodies. Now, a lack of bodies has always been, of course, a conversation here in this room, but it's always been California specific. Now it's national. Now it's national. The reason it's national, well, again, demographics. I've told you about this over the last bunch of years. Boomers all came out of families of 12 kids, all had 2.2 kids, right? Population pyramid turned into a population column. Now that boomers are retiring, you get, every boomer that retires, you get one Gen Z coming in to the labor force, whining, kicking, screaming, complaining, and completely unhappy about it every step of the way. A number of them work for me. I'm working on them. But the pandemic caused 2.5 million people to retire, and suddenly labor shortages went from something that was going to happen to something that is completely current. And by the way, labor shortages aren't going anywhere in the United States. According to the census, growth in people in their prime working years over the next 2 decades is functionally zero. So this is going to be an ongoing dogfight for workers over the next couple decades. Get used to it. And yes, by the way, that also means that if you're worried about income inequality, you don't have to worry about it so much anymore. You know, people in the bottom quartile of earnings have seen their earnings rise faster than everybody else in the workforce since 2016. Let me repeat that. Income inequality in the United States has been falling for 6 years. Has anybody seen that in the New York Times? Right? I mean, we continue to be panicked about income inequality when the problem is solving itself, right? But again, in the world of miserableism, you have to continue to focus on whatever thing, anything you could paint the picture as being bad and horrible and dismal and declining, you will continue to beat on that drum no matter how long ago that boat passed. And so they continue to talk about this, even though it's just not an issue. Now in California, of course, we're not quite back to where we were. And I still love this. They still talk about that. I saw this in the paper this morning. They're like, oh, California, we're almost recovered. Well, what do you mean by almost recovered? Well, jobs are almost back to where they were pre-pandemic. What is that supposed to mean? Look, some states like Arizona have more jobs today than they did pre-pandemic. California has fewer. So what? There's one thing that every part of this nation has in common. I don't care if you're in Dallas, Texas, or in San Jose, California. I don't care if you're blue or red. I don't care if you're low tech or high tech. The one thing that every part of this economy shares in common is help wanted signs. Nobody has enough workers anywhere. And the idea that you can compare the number of jobs to 3 years ago and call that some metric is ridiculous. There's not enough people anywhere. And indeed, if you look at the Bay Area, for the most part, San Jose actually is above its pre-pandemic level of jobs. San Francisco and San Jose are well below. But when you look across the Bay Area, the biggest problem is not so much that there's any issue, if you will, with demand for workers, but there's nobody to hire. The big retirement wave. Look at the unemployment rates up here right now. They're incredibly low. I'm not even going to worry about this. We'll come back to that. Unemployment rate right now across the Bay Area, a little bit below where it was pre-pandemic. For the state overall, it's lower than it's ever been. It goes down to, back to, and on, the same thing we've talked about year after year after year. The biggest problem in the Bay Area and California in general is you don't build housing. If you don't build it, they're not going to come. Well, the solution, by the way, to our labor problems is simple. Build more housing. You can't say that in Texas. All right? Simple as that. Now, again, I don't need to beat on this horse. We've beat on it lots in the past. But obviously, thinking about expanding your labor force is economic development. And that's true now in the Bay Area. Even in this chaos, it is still a housing conversation. The economic potential in this region is enormous if the region would simply build sufficient housing. No more, no less. Don't overcomplicate it. Just that simple. Now, of course, with interest rates coming up, residential markets are sagging pretty hard. Existing home sales are down. Case-Shiller numbers suggest prices are starting to fall. You certainly see a big drop off in sales here. And prices, well, they're starting to cool off. Prices always lag sales by a year. So prices will probably start to come down in early 2023 by some modest amount. I don't think there's any doubt about that. But again, coming down from what? 1.66 million for a median house in Santa Clara County? Do you know what the median house in Santa Clara County looks like? It's 1/7 of an acre. It's 2,300 square feet, 1.5 bathroom, and probably still has, what is it, autumn and what's the autumn gold and what's the horrible green? We all remember the 1980s, right? All right? It's just insanity. Housing starts, of course, are cooling off. New homes for sale are going up pretty dramatically. Permits still look good, but obviously demand to build homes is going to come down because of all this chaos. But this is a sticker shock problem, right? Just look at the price of a new home. When you go from 3% to 7%, the price of a new home in the U.S. went from $17,000 a year to $26,000 a year. There's a big sticker shock. Obviously, it's a problem. And yes, sellers and buyers have to start rethinking everything they were thinking about. Sellers, well, you're going to probably have to take a lower price. Buyers, you're probably going to have to put more money down. And yes, that is an option. You can put more than 20% down. These are all conversations we're going to have. But with that in mind, well, I'm not worried about that. Let's also keep in mind why the market isn't going to implode. Okay? Take, for example, equity. At the very bottom of the post-pandemic economy, at the post-Great Recession economy, we had about $10 trillion of equity in the U.S. housing market. Today, we're getting close to $30 trillion. So in a decade, we went from $10 trillion to $30 trillion of equity. Credit right now is the best it's ever been. Debt to equity ratios, close to the lowest they've ever been. This is not an imploding market. This is a market that, fundamentally speaking, is rock solid. Excess supply of units doesn't exist. Just take a look at the West. For sale for rent in 2008, 3.6%. For sale for rent in 2012, 3.5%. Today, 2%. There's nothing available. This is not a market that's going to implode. Look at for all the huge increase in new homes for sale in the U.S., look at existing homes for sale. We're not even back to 3 months supply for all the stuff that's going on right now. California's housing vacancy in 2021, lowest it has ever been. And of course, when you think about housing, we have to think about what I would call the valuations at the asset level, but what about underlying demand? Typically, when housing markets collapse, they're collapsing in part because of an underlying collapse in demand. That is to say, rents are going down, vacancy rates are going up. You should be seeing it in apartments. Well, you're certainly not seeing this in apartments. If anything, the colder housing gets, the hotter apartments get. Look at rents going through the roof, vacancy rates remaining really tight in the U.S. right now. Even here in the Bay Area, sure, there's a pandemic down, but now rents are starting to come up, vacancy rates are starting to come down. Clearly, demand for housing services is still incredibly strong. So the asset fundamentals are strong, demand is strong, it's just the valuation part that's screwed up because of the big height in interest rates. Yes, it's going to be very cold in the buying and selling part of the housing market, but everything else looks great. It's just a function of dealing with the new realities of interest rates. As for non-res markets, we never saw much, if you will, of a big pandemic pullback because, well, non-res markets work on 3 or 4 year cycles, and the pandemic was a year cycle. Permits actually looking pretty good right now. But yet again, we have a pricing problem. Cap rates came way down in the bubble, and now they're going to have to come back up again. And that means, of course, a decline in commercial prices. And I have some friends who work in that commercial real estate space, and they're not doing anything. They're getting ready to take a month hiatus because the market's gone dead cold. But permits are actually looking pretty decent right now. If you look at some of the fundamentals, industrial, hot as all get out. Retail is actually pretty steady. It's only really office space we're seeing a lot of stress. And that, of course, brings me back even to conversations about the Bay Area particularly. Because if there's one giant panic in the Bay Area. It's about an excessive amount of office space. And I do kind of agree with that, but I would argue that the excessive amount of office space isn't driven by a collapse in demand for office. I don't think that's true. There's a decline in demand for office, but it's evolution, not revolution. The problem is the Bay Area, particularly San Francisco, built way too much commodity space over the last 5, 6, 7 years. Way too much. It didn't make any sense, right? And now, of course, that, if you will, bubble has cooled and we're facing some of the fundamental realities. But in terms of the work from home situation, look, my company is a classic case of that, right? I haven't gotten my people back. I haven't. But with that in mind, we basically required them to come into work 2 to 3 times a week. And they're coming in 2 times a week. We'll push for 3 later in the year, right? Go back to labor shortages. Here's the point. If your person's coming in 2 days a week, they still want an office. They still want their picture of their kids on the wall. They still want a filing cabinet. And by the way, you as a manager, you don't care that they're not there 3 days a week as long as they're producing work. So really, it isn't quite what people are saying. And even here in San Jose, you look around, it's interesting. You see the big declines around the airport in Militas, and of course the Cupertino, big decline, big net absorption decline. But other markets that aren't so well supplied, Palo Alto, San Jose submarket, Santa Clara, they're doing fine. So it's really those big commodity markets where they built tons of office space that you didn't really need, where you're seeing the problems. It isn't that big of a deal. Take a deep breath. Take a deep breath. So ultimately, the biggest problems we're facing from a long-run perspective goes back to this $1 trillion plus structural deficit, this huge amount of debt we have, all, of course, in the face of the huge increase in debt that's going to occur because all the retiring boomers and the spending on Medicare and Social Security for those folks. These are the big problems. $20,000 in federal debt per person in the last 2 years. 130% debt to GDP. Clearly not sustainable. And I would love to tell you that I have a prediction for when this particular situation breaks. I don't. If the bond markets were truly looking at the U.S. and were worried about where we were, the dollar should be falling, not going through the roof. For whatever reasons, they still view us as a safe haven, which is intriguing and certainly not permanent. But at least in the short run, this is still a longer-term problem. When does this hit? Good news for me is I get to keep coming back every single year until it happens. And then, of course, we won't have these talks anymore because no one can afford it. The bigger problem, of course, is the state level. Because over the last 2 years, despite all my shrieking to the opposite, they viewed all this money flowing into Sacramento as all this extra money they could spend. How many times have we seen this? We had a huge surge in capital gains revenues in the late 90s that turned into massive deficits in the early part of the century. And we had a huge surge in revenues in the run-up to the Great Recession that turned into John Chung handing out IOUs to vendors to the state because we were running out of cash in 2009, 10, and 11. We saw a huge surge in revenues, and apparently no one remembered those last 2 cycles, including us. And yeah, now it's starting to come apart. Suddenly, no more IPOs, no more huge big capital gain surges, and yeah, we're only 3 months in and we're already 16% below what the Department of Finance was forecasting. So while the federal government may have, shall we say, a longer runway, problems at the state level are clearly here already. So be prepared for that issue as well. So, if I had to wrap it all up, expansion is going to continue. Wealth and income will continue to drive spending. Yes, construction is going to go into deep freeze. Inflation will continue to run hot. The economy will be brittle, but I don't see any reason to predict a recession in the next 2 years, not with so much consumer demand. Silicon Valley, still a giant. Yes, things are settling out. It is a different game, but demand for high tech to remain. Local economy remains hampered by a lack of housing. Office being hit by changes in workplace, but isn't as bad as you think. The bigger problem, obviously, is that easy money that so drove so much craziness is not going to be there. You're going to have to do it the old-fashioned way. You're going to have to earn it. Sorry, Silicon Valley. As for real estate, chilly yet hot. Again, the asset values have a big fundamental problem with valuations, but the underlying demand remains there. As for the potential scenarios, again, what will the Fed do? What they should do is sit on their hands and do nothing. I don't know what they will do. I just can't tell you. What's the fiscal situation? Where is the US dollar going? And of course, most scary of all, what exactly is going to happen between this gap between the economic narrative and economic realities? They're not in touch. Simple as that. Simple as that. Now, with all that in mind, there's one other wild card we have to worry about. And this is an important one, okay? I don't try to dive into this stuff too much, but you know, the Phillies are in the World Series, okay? And to be clear, the Philadelphia won the World Series in 1929, 1930, 1980, and 2008. Look it up. I hate Houston with a passion that only a Dodgers fan can hold. Folks, you got to root for Houston. You got to do it. Phillies win. It's all over with the shouting, straight into the depression. Be prepared. And with that,
good job.
I'm somewhat sober. I'm not hoarse from screaming. I'm not sweaty.
What's wrong?
I don't know. Maybe this new format is kind of good. I don't know.
I'll take a few questions.
Mark, do you want to yell at me? Anything? No? All right. No, Mark's not going to. Okay. Questions then. This is a good time. Again, small audience. Let's do it. Again, forward rates, right? It's all the Fed. It's honestly not inflation. The bond markets think inflation is going to go away. So they're just not thinking about it, right? So it's all about what the Fed does. Oh, the question was, where are rates going? And that all boils down to what the Fed does. And on that, listen, I get this question all the time, which is, what is that crazy guy going to say next? And my answer is, if I knew that, he wouldn't be crazy. The question you're asking me is really about what will Jerome Powell do? What will this Federal Reserve Board do? I don't know. They shouldn't have printed $5 trillion, and they shouldn't have cranked up the federal funds rate to 3% in a completely quixotic attempt to stop inflation, which isn't going to work.
But from your perspective, what's the catalyst for a rate reduction rather than a persistent increase?
What's the catalyst for a rate reduction as opposed to a persistent increase? What we're looking for is a hike, basically it's cooling of inflation and a hike in unemployment, right? But go back to what I said about cash on hand, consumer demand. The fact that, look, money, whether it's wealth or income that goes to the bottom 50% of the pyramid, immediately turns into consumer spending. Okay, it just does. That's the system. And right now, people at the bottom 50% of the earnings ratios are seeing the highest pay raises they've seen in the 35 years we collected this data. Highest in 35 years. They have a 100% plus increase in their wealth, 100% plus increase in their cash holdings. They're going to continue to spend. So these interest rates mean nothing to these folks. Inflation is going to continue, and all he's doing by cranking up the rates is hurting the financial markets, hurting real estate, hurting banks, and not stopping inflation. So everything he's doing is completely irrelevant. So if he continues to crank, which he probably will under those circumstances, then yeah, he could crank it till he breaks it. And then that's a different question. But I don't know. Yeah.
There's a rumor.
A rumor. On where?
They're going to take
Wait, hang on. From where?
CNBC.
Okay, stop. Okay, time. I'm going to stop right there. Do not watch 24-hour news networks. Do not do heroin. Do not watch 24-hour news networks.
The Fed said that they were going to, the rates were going to go to 5.7 next year.
Who knows?
Go down.
It doesn't. The Fed makes a decision. The Fed makes a decision every few months when they meet. CNBC doesn't know jack about what's going to happen next year. No. Yeah, that's not. Yes, sir.
Hi, Chris.
Hi.
So we've had several companies report lately, Microsoft being one of them, Alphabet or Google another. I believe Amazon's coming up here.
Mm-hmm.
We had Meta today.
Okay.
I believe all of them are showing big misses on the advertising side. So they're shutting down advertising.
Yeah.
So it's hitting their bottom line really hard. Why is that happening at the corporate level right now if the consumers?
Well, that's the question, because everybody thinks the consumer is going to be weak because all these companies keep reading the papers and hearing about a recession, and they're pulling back on their contracts. But the consumer demand isn't going to go anywhere. That's the key. We keep coming back to the idea that look, it's the same question you can ask me is, why did Walmart and Target make so many pajamas? Did they really think we were never going to leave our bedrooms again? We're just going to live in our homes and never go outside and spend our entire life looking at a screen? Look, I had a buddy of mine who bought something from Target and it was wrong or broken or something, and he went back and they're like, yeah, I want to return this. Say, hey, here's your money. And he's like giving him stuff. They go, no, we can't take that. Why not? We don't have room for it. Just keep it. So businesses are making decisions on the basis of what they're reading in the papers. There's a real problem there.
They're taking it in the short on purpose.
They think they're doing the right thing.
These are smart.
Retail spending has not dropped a bit. Vegas is busy as it's ever been. I don't see any sign of. I keep hearing about massive Christmas spending already starting to happen. I can't tell you why they're doing it. What I know is consumer demand is not going anywhere.
China and Russia making a gold-backed currency to usurp the U.S. dollar.
Oh, sure. First thing I'm going to do is invest in Russia and Chinese securities. I trust. If you can't trust Putin, who can you trust?
He's got to build some munitions.
Well, China's there.
China is being taken over by a dictator. Their economy is a train wreck. Their real estate sector is imploding. They have huge problems over there. I don't know what the hell they're going to do. Now, mind you, they could. Look, let me tell you about China for a second. Everything says real estate's starting to go down there, big time, as well it should. But understand that the Chinese government has made a very interesting bargain. They've been unwilling to allow their economy to develop in certain ways, and so they've made this weird bargain, which is, I'm going to keep unemployment low by building empty cities. How many empty cities can you build before that model finally collapses? If they really start to see problems, they can bail out the financial system. The financial system will continue to pay builders to build empty cities. I guess. Again, I don't know. The Chinese economy is a black box, and anybody who pretends they fully understand it is only kidding themselves or kidding you. But clearly they're having big problems. They are being taken over by a dictator, and I'm very worried about China, but not that they're going to supplant the US dollar. I mean, this goes back to the idea that we have a $1 trillion plus structural deficit. We have a 130% debt to GDP ratio. Our government is seemingly all doing laughing gas at the same time when they're making decisions, and the dollar is at an all-time high level. This is the shortest midget in the room situation, okay? I'm sorry, tallest midget in the room situation, right? It is what it is. I say all these things and we start to get depressed and everything else. I will also say something else which I think is important in the midst of all this. Look, people, for all the chaos in the world around us today, there's nothing new in this. Political narratives going awry from anything resembling reality is time honored. You go back thousands of years and you'll see it in Egyptians and Sumerians and every other ancient civilization. We still have an increasing quality of life, no matter how you look at it. I don't care what the official statistics say, they're completely wrong. Any millennial who thinks they have a worse standard of living than me when I was their age, I would love to put them in a time machine and send them back to my life when I was 23 years old, living in Rochester, New York, driving on a rear-wheel drive car with no anti-lock brakes, with bald tires, with no cell phone, in snowstorms in Rochester, New York, spinning around, landing in snowdrifts and laughing it off. Just, yeah, good cell phone? What's a cell phone? Well, hey, that's true. I'll grant you that. Mind you, I got about 2 miles a gallon, so. So again, I mean, for all the chaos, the reality is, and this is the most tragic part of all this, is we really do live in a time of plenty. Our lives are magnificent. And the fact that the only thing we do is sit around and whine and moan and complain about it says a hell of a lot more about us than it does about the economy.